Assalamualaikum warahmatullahi ta'ala wabarakatuh. Welcome back. As I promised, there will be more session via online. And today we're going to discuss question November 2019 common test. We are going to discuss question 2. So I hope you have the common test question right in front of you now. Okay, so if you look at page 3 of the test paper, okay, the first part asks you about determine the 3 characteristics of intangible assets for 3 marks. So the 3 characteristics of intangible assets are actually the one that have been discussed in the earlier parts when we had our lecture, right? If you can still recall, the first one is identifiable. You can check that answer or can check that by referring to the textbook, or you can also refer to the handouts that were earlier given, the part on the recognition criteria starting from slide number 14 up till slide number up till slide number subsequent measurement is not in that, so it's in the first few slides, so you can check your notes for that. But here, identifiable, yeah, and you need to discuss about what is meant by identifiable. Remember we talked about before this separable. We also talk about having some kind of contractual or legal right, so you need to put that in your answer, right? The second point is about control. Maybe you can also put here, control here is the control over the resources, where it means that you have the power to obtain the future economic benefits as well as having to restrict others from having access to the so-called resources, which is the intangible assets. The next one is that the future economic benefits is probable. When we are talking about the revenue that may have been generated from the sale of the product or the services that have used these intangible assets, or maybe on the cost savings. If you cannot have the revenues, you can cut some cost. And the last one, you need to discuss on whether or not the cost can be reliably measured. So normally costs can be reliably measured if you can or you can have the information on the purchase price or the contract price or the initial costs. Okay, that's for the first part. Now we look at the second part, which is part B. So in this part, or part B, you are actually asked on We check the question. Yeah? To decide actually which of the above expenditure that can be capitalized and which of it cannot be capitalized, right? So if you can still recall, when we talk about initial cost before this, initial cost of an asset, or here is an intangible asset, it is actually with the purchase price plus directly attributable cost. So here if you look at the first item, that falls under directly attributable costs, which are the costs to prepare the asset, this one here, to prepare the asset for its intended use. And for its intended use means it's ready to be able to be used in the so-called business, right? You can refer the textbook page 438, or you can also refer the notes at page 29 for that part on directly attributable costs. Some of them costs like the cost which is like import duties, legal fees, and so forth. And let's see whether we have it here. So direct employee cost to install and bring the system to its working condition. So this is actually a directly attributable cost. Okay, so this is directly attributable cost. And then you have this, and therefore for directly attributable cost, it has to be capitalized. The next one, you have additional professional fees that you need to pay to the supplier to customize the system for their intended use, meaning that if you do not have this supplier that customizes the system, it will not be ready. So this is also another example of directly attributable costs. The next one is cost of testing to ascertain whether the asset is functioning properly, meaning that whether it is capable of operating in the manner it is intended to be. So this is also directly attributable cost. 1, 2, 3 is directly attributable cost. Yeah, and for your information, for directly attributable cost, it will be capitalized. So you need to write up that. So you would say maybe item 1, 2, and 3 are directly attributable costs. Are directly attributable costs. And therefore, it needs to be capitalized as part of the cost of the intangible asset. So this will be capitalized as part of cost of the intangible asset. So remember, it's 1, 2, and 3. These are directly attributable costs. The next one, if you cannot capitalize, what you have for another option is that if it's just incurred to run the business smoothly, or just the operating cost of the business, therefore these expenses needs to be written off. It is recorded, but it cannot be capitalized as part of the cost of intangible assets, so therefore it needs to be expense off. So let's look at this expense or the costs that were incurred. So these are the costs, like for example, item number 4. Item number 4 where cost of introducing a new service, you introduce a service to the customer, so it's like a promotion, right? So that one has to be expensed off. Admin, cost of launching is more like trying to introduce as well, but this one is launching a new service for a new segment, so these are also expense off. Next one is the admin. The word is clear here, admin and general over here, so these are the admin cost, of course, admin expenses, right? Cost incurred to maintain. So when you have a cost incurred just to maintain the system to be able to operate in the manner it's intended to be, just to maintain, so that one is just some day-to-day cost, and therefore that has to be expense off, not to be capitalized. The last one, initial operating loss incurred in introducing the systems and the new services, so these are also to be expense off. So we are talking about item 4, 5, 6, 7 and 8. So item 4, 5, 6, 7 and 8, it is not directly attributable cost, right? So if it's not directly attributable cost, it has to be some what you call revenue expenditure. So revenue expenditure, if you can still recall, it has to be expense off. So it has to be expense off. So meaning that it cannot be capitalized. So that's the first part done. The second part now, part B, is done too. So let's move on to the next part, which is part C. This is the part that will relate to the knowledge of R&D. Okay, let's look at the information given. You have the company Kader. I'm not sure how's the pronunciation, Kader Berhad, maybe carried out a research and development. So it's an R&D project, research and development, to produce a new aroma coffee product. Maybe like what is viral now, the so-called dalgona, but that's not a new aroma. It's just a new way of making your coffee more interesting, but actually the taste is more like similar to what you have tasted before. And it says that if you are able to produce this new aroma, that will significantly increase. So it's a new aroma is something that not available before, so it's a new invention, I think. So it's a new invention. And you have the year end, 31st of December 2018. They incurred a total R&D cost of 4.8 million. So the total R&D is 4.8 million. And that is for the year ended 1st of January 2018 up till 31st of December 2018. That was the duration of the project, because it says year ended 31st of December, incurred a total cost of 4.8 million to develop this new aroma. And you are also informed here, if you read, there was a research phase for the 4 months. So from 1st of January 2018 up till 30th of March. Here is the research phase. So under research phase, you may have some research costs incurred. And the research cost is 0.95 million or 950,000, and that was for the first 4 months. And if you go on reading, you will have some information given later, which is what happened somewhere in May. So somewhere in May, the company was very certain of the acceptance and expected an increase of profit in November. So they was very certain. So the development started in May. So if you can see, the development project is for this period, for the remaining 8 months, which start on 1st of May, and only somewhere in November, meaning that somewhere here, 1st of November, that you are certain. So there will be some cost here, and there will be also some cost here, but it has to be spread evenly. So if you can see that this period or development, the duration for the development cost was for 8 months. For the research phase was for 4 months. Okay. So meaning that you need to go and see that the part that they are not certain, or in other words, the part that it does not meet the capitalization criteria, is this 1st of May up till 1st of November, which that one will be 6 months, and the part that development costs meet the capitalization criteria, meaning that they are certain that the customers, based on this information here, certain on the customer's acceptance, will be somewhere from 1st of November up to 31st of December 2018. And that is another 2 out of 8 months. So if you were to calculate the cost, development cost, that you will have to be, that you need to expense of because it does not meet the criteria, it should be 6/8 times the remaining development cost. So if you use your calculator, you should be able to get the figure correctly, right? And it is actually 4.8, the total, minus 0.95 million. So you'll get a figure of 288,700. So that one would be 288,500. And this one will have to be expense off. The next one is for the one that meet the criteria, this will have to be capitalized as IA. So how much development costs that will be capitalized as intangible asset would be the one from 1st of November up till 31st of December, where that one would be 4.8. Oopsie daisy. Never mind. Okay, development costs capitalized. Will be 4.8 million, right? Minus 950, and then times 2/8, and that will give you 9,625,000. So 9,625,000 is the one that you need to capitalize. Okay, that was just what is going on, or what was given the question, or in terms of planning how to do the accounting treatment as required in the question. So what were actually required were this: explain the accounting treatment for each phase of the research and development for the year ended 31st of December. Before we do that, I would like to add some journal entries just as a value added advantage for you. So I'm going to show you the journal entry that happened in the year 2018, which relates to this development costs. So this one is for the year ended 31st of December 2018. So we record what happened for that year. So the first one, debit research costs, debit development costs, and credit bank or credit payable. The total cost was 4.8 million. The one that relates to research is 950,000 or 0.95 million. Therefore, the one that relates to the development project would be the difference, which is 4.8 million minus 0.95 million. And that is 3.85 million. That was the first thing. The second one, you know that this has to be expense off. But for this one, part of it will be expense off, part of it will be capitalized. The part that will be expense of are the total research costs plus some of the development costs. So we need to do another journal entry for that. So I hope you have copied down that part, because I'm going to go to the next part, which is to do the to write off the research and development where applicable. So now is to expense of research costs. So number 2, debit SOPL under the admin expenses, and you will credit your total research cost. Remember, it was 0.95 million. The third one is to expense of the development costs. That, which one? The one that does not meet the capitalization criteria. So that one will be done in the next journal. So therefore it will be debit development cost. Remember, we did this calculation much earlier, which is 6/8 times 3850, and that gives you 2887 500. So this will be debited to the SOPL and credited to the development costs, 2887 500. Okay, we are done with the journal entry for that year. So now, just that one is just, as I said, is a bonus thing for you, so that you know how to do the journal entry. Now we move on to the thing that is actually required from the question. Which is the accounting treatment for each phase, meaning that research phase, how you treat the expenses in that research phase, and development phase, which is for the year ended 31st of December 2018. Okay, let me just also share with you that for development cost that is capitalized, it can also be amortized, right? So I'm going to add a little bit later on the amortization of development costs. But before that, let us look at the accounting treatment for the requirement A, and also requirement B is on the criteria for capitalization. Remember, I mentioned last time about the word sector, if you can still recall, the 6 criteria. So these are the things that you need to include. Where this one is cell, please recall that. This one is about the expenditure can be reliably measured or not. This one is whether there is an intention to complete. This is on technical feasibility. O is on whether or not there is a market for the output, and R is whether or not it can be reliably measured. What can be reliably measured? The project, the cost of R and D. So let's look at the suggested answer. You may have a different answer, but this is just some suggested answer that I will just share with you very quickly. Okay, let us look at straight away the part on just bear with me. Yeah, let us recommended answer or for the question 2 part B. Okay, for this part A, I won't be going through anymore because these are so similar to those past exam question that you may past common test question that you may come across. But if you look at my focus is this one, which is part C. So if you look, what we earlier planned has already been the maybe your guideline to write your answer. So you can either write your answer in this paragraph form, or you can also do that in your table. Yeah, maybe put some table, columnar table. Okay. So you need to talk about during research phase. Yeah. You need to mention about what are the research costs. Yeah. The research cost of 950,000, and these are the accounting treatment which are important for you to take note. Which is to be written off. You can also use the word to be expense of to be expense of in the SOPL. That was the first part. The second part is on the development phase, which starts from 1st of May until 31st of October. Remember, research phase is from 1st of January until 30th of April. So for that first 6 months, 6 out of 8 months, remember the development phase was for 8 months. The first 6 months, it does not meet the recognition criteria based on the sentence in the question that we earlier detected, that is where the company was not yet certain on the customer's acceptance. So therefore, they will have to be following the requirement of MFRS 138, which is to expense off. You can use the word expense off in the SOPL, or you can also use being written off. But you must mention the word it does not meet the recognition criteria, or maybe the future economic benefits are not probable, are not yet certain. You can mention that. Right. Next is the development phase that starts from 1st of November up till 31st of December 2018, which is the remaining 2 out of the 8 month. And the amount we have already calculated. So those amounts are said to meet the criteria for capitalization, meaning that you can recognize that as intangible asset. How much? The amount that you need to recognize is 962,500 as intangible assets. So this amount will be recognized as an asset in the SOFP. Let's say if you prepare your extract of SOFP as at 31st of December 18. Yeah. Okay, I think I better do it in the next page. Let's say we do it here, the bottom of this. Okay. Mind the noise, yeah, because this is at home, so you can hear a lot of background music from my kitchen. So I hope you don't mind, yeah, with the background music, because I'm doing this live at home. Of course, there are a lot of people, especially during this movement control order, that everyone is at home, so it's not easy to control. So these non-current asset, remember we were talking about the development costs. Development costs that will be carried in the SOFP will just be, which one? The amount that is being capitalized. This is as at 31st of December 2018, which is 962,500. And if you prepare extract of SOPL, yeah, statement of financial performance, that you can also call them SOPL, for the year ended 31st of December 18. If you do this, you will see that under your admin expenses, you will have two types of expenses. One is going to be your research costs. Another one would be your development costs. Okay, I'm just erasing the previous statement. Okay, so this is extract of SOPL for the year ended 31st of December 18. So you will have your admin costs, and under your admin costs there will be two items. One is your research cost, that is to be expensed of 950,000, and your development cost that will be expense of 2,887,500. But let's say in the following year, let's say you assume development costs has an expected development costs let's say you assume development costs, assume there is some kind of amortization of development costs. If there is amortization, let's say over estimated useful life of say 4 years. So amortization will not take place in 31st of December 2018. It will start beginning 1st of January 2019 onwards. And let's say if you prepare another SOPL the following year, your development costs will have some kind of amortization of development costs. And how much? It will be the figure that you put in your SOFP just now. Remember, it was 962,500 divided by 4 years. If I assume that to be 4 years. So if that is 4 years, if you take your calculator now and calculate, press the figure correctly, it is going to be 240,625. And these are all expenses, not here, but it will be in the following year. 240,625. If you assume development costs were being practiced. Next one. I go to the last part. I'm going to stop in this few minutes time. I'm going to show you the extra of SOFP for that 2 years. Extract of SOFP as at. First is as at 31st of December 18. Another one would be as at 31st of December 19. Under non-current asset. So what you will see is that in the first year, development cost is what you calculate much earlier, which is $962,500. However, in the second year, you would see that this $962,500, which is the cost, will have to be deducted with the accumulated amortization. And we have already calculated earlier that the amortization was 240,625. 240,625. If you take your calculator, I'm taking my calculator now. You press 962,500 minus 240,625. That will give you 721,875. 721,875. Okay, with that, I've already shown you the complete accounting treatment for R&D with some extra, which is, what are the two extras? Number one is that I also show you the journal entry. And number two, I also showed the extract of financial statement, not just for 2018, but also for 2019. And remember, in 2019, I make an assumption that if and only if the development cost is being amortized, and I assume the expected useful life is 4 years. So I hope you have at least acquired knowledge on R&D, and now you are able to do more question on R&D. And with that, I hope that you'll be able to write the answer as I've shown you earlier. You should be able to rewrite your answer properly, yeah, as I show here. You can see here, right? Earlier I showed you, and this part, as I said, the characteristic of intangible asset for the question 2A, you can check it out in your textbook, or you can also check it out in your PowerPoint slide notes. With that, that's it for today. I'll see you when I will see you. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi ta'ala wabarakatuh.